There's a precise moment when a currency's decline stops being an abstract metric on a financial terminal and begins showing up in the foundational architecture of the global economy. When the US dollar undergoes a sustained structural slide, it does not merely alter daily exchange rates, it alters the fundamental cost of capital, redefines international trade relationships, and forces institutional balance sheets to seek shelter outside paper fiat. As the dollar's purchasing power erodes under the weight of mounting sovereign deficits, gold has quietly breached unprecedented milestone levels, signaling that global markets are actively searching for an undebasable anchor. This is not a sudden, erratic spike driven by panic, but the inevitable mechanical reaction of a financial system watching its primary reserve currency lose structural traction. Yesterday, we explored how gold's historic rise above the $4,500 threshold exposed a growing divide between nominal interest rate policy and real debasement risk. If you are tuning in from Toronto, London, Singapore, or anywhere else across our global community tonight, drop your city in the comments below, as this ongoing currency evolution affects every portfolio on Earth. Today, we turn our attention directly to the catalyst sitting at the heart of this shift, the accelerating slide of the US dollar. To fully grasp why a falling dollar acts as a high-powered catalyst for gold's march into uncharted territory, one must examine the mechanics of foreign exchange and global reserve management. For decades, the global financial system operated on a simple premise. International counterparties accumulated US dollars through trade surpluses and recycled those greenbacks directly into US treasuries. This dynamic created an artificial, perpetual demand for the dollar, allowing the United States to fund expansive fiscal deficits while maintaining relatively low domestic borrowing costs. However, when the purchasing power of that benchmark currency begins to slip systematically against tangible commodities, foreign central banks face a compounding risk. Wealth managers and central bank governors are no longer asking whether short-term interest rate cuts will push the dollar up or down over the next quarter. Instead, they are evaluating a multi-decade trend of supply expansion, where the total volume of paper units in circulation outpaces the real growth of goods, services, and physical assets. If you are finding this breakdown valuable for navigating today's shifting monetary landscape, take a quick moment to subscribe to the channel and hit the notification bell so you never miss an episode in this series. When the dollar loses its momentum, the immediate ripple effect extends far beyond currency desks. Commodities worldwide are priced natively in greenbacks. When the exchange value of the currency drops, it requires fundamentally more paper units to purchase the exact same barrel of oil, bushel of wheat, or ounce of fine gold. But in the current economic landscape, gold is performing a dual role. It is benefiting both from the standard mathematical adjustment of a falling currency and from its traditional status as the ultimate non-sovereign reserve. As sovereign debt obligations swell worldwide, investors are recognizing that currency debasement is not a temporary policy choice, but the path of least resistance for indebted governments. This structural reality has set off a steady capital migration out of paper promises and into physical assets, pushing gold up to its latest historic milestone. As the US dollar continues its structural slide, the mechanics behind this currency migration reveal a profound shift in how international trade and reserve allocations operate. For over half a century, the petrodollar system and global trade clearing mechanisms anchored international demand for greenbacks, compelling foreign nations to hold vast liquidity pools in US short-term paper. But as structural deficits expand and the purchasing power of paper fiat faces steady erosion, sovereign states are increasingly settling cross-border balance sheets in alternative currencies while parking surplus liquidity into tangible assets. This structural realignment is not merely a hedge, it is a strategic decoupling from paper asset counterparty risk. When global central banks allocate billions away from sovereign debt into physical bullion, they are essentially taking delivery of an asset that cannot be printed, diluted, or frozen by decree. This capital flight out of paper debt instruments and into non-sovereign reserves has fundamentally altered how institutional trading desks calculate value across global markets. Historically, when bond yields rose, non-income-bearing assets like gold experienced sharp sell-offs as capital sought high-yielding cash alternatives. However, that traditional dynamic breaks down entirely when systemic debt expansion outpaces nominal yields. When global asset managers calculate their real, inflation-adjusted returns, they find that earning nominal yield in a currency expanding its supply at a faster clip results in an absolute loss of real purchasing power. If you are following this macroeconomic transition from Sydney, Mumbai, Dubai, or anywhere else around the world, drop your location in the comments below and share how your local currency has performed against physical assets over the past year. Also, if this deep dive is helping you understand the forces driving today's markets, please hit the like button and share the video with fellow investors. The pressure on the dollar is further amplified by the mathematical reality facing central banks worldwide. Policymakers are trapped inside a severe structural feedback loop. If monetary authorities attempt to raise benchmark interest rates to defend the exchange rate of their paper currency, the annual cost of servicing massive national debt burdens spikes dramatically, triggering even larger fiscal deficits that ultimately require more currency creation to fund. Conversely, if policymakers lower interest rates to ease debt service obligations, real yields plunge deeper into negative territory, accelerating capital outflow into physical reserves like gold. It is precisely this structural policy box that institutional treasuries are monitoring, recognizing that regardless of short-term rate tweaks, the long-term trend points toward persistent purchasing power degradation. As gold establishes new historical floors in response to the dollar's erosion, retail and institutional participants alike are being forced to rethink traditional portfolio diversification models. For decades, the standard 60-40 asset allocation model relied on sovereign bonds to provide safety and yield during periods of equity market volatility. But in a macro environment characterized by perpetual deficit spending and accelerating debt monetization, government paper no longer acts as an uncompromised safe haven. It carries systemic duration and currency debasement risk. As a result, large multi-asset funds, pension desks, and sovereign wealth entities are systematically increasing their strategic allocations to physical bullion and hard commodities, creating an unprecedented institutional bid under the metal. This steady accumulation of physical bullion by global institutions is silently absorbing available vault liquidity across major trading hubs from London to Zurich. Unlike paper futures contracts, which can be expanded exponentially on leverage, physical metal reserves are strictly limited by real-world extraction dynamics, energy costs, and refining capacity. As physical bars move into permanent sovereign custody, the paper derivative markets face a tightening squeeze, forcing commercial bullion banks to continuously reprice their physical delivery premiums higher. The dollar's slide is therefore acting as the main catalyst for a broader structural repricing, exposing the growing divergence between paper currency supply and the finite reality of physical economic reserves. As gold consolidates its gains above key historic thresholds, the narrative surrounding its rally is undergoing a fundamental transformation. What began as an institutional hedge against routine monetary expansion has evolved into an active repricing of sovereign balance sheets worldwide. For decades, traditional macroeconomic models suggested that a strong paper dollar would suppress hard commodity prices, relying on high nominal yields to retain global capital. However, in an era defined by persistent debt expansion and unanchored fiscal spending, nominal yield alone is no longer enough to satisfy sovereign treasuries or major multi-asset funds. When real, inflation-adjusted returns remain negative or deeply compressed, capital naturally flows away from paper liabilities and toward tangible, undebasable reserves. This dynamic has created a severe structural dilemma for foreign central banks and global trade counterparties. For over half a century, Western sovereign debt served as the primary collateral for international liquidity and trade settlement. Today, as foreign monetary authorities systematically reduce their reliance on foreign paper debt, physical bullion has reemerged as the premier asset with zero counterparty risk and absolute sovereign immunity. As global central banks quietly accumulate gold at historic annual rates, available physical supply across primary vaulting centers in London, Zurich, and Shanghai is being locked away for the long term. If you have been following this macroeconomic breakdown from Frankfurt, Tokyo, Riyadh, or anywhere else across our global audience, drop your location in the comments below and share your thoughts on where sovereign reserve policies are headed next. Also, take a moment to hit the subscribe button, like the video, and share this analysis with anyone navigating today's financial markets. The ongoing slide of the dollar is far more than a temporary forex trend. It represents a mechanical rebalancing of the global monetary hierarchy. When currency debasement accelerates, nominal prices for equities, real estate, and strategic commodities may all move higher, creating an illusion of growing wealth. Yet, investors who look strictly at nominal returns often miss the underlying loss of real purchasing power. Earning nominal gains in a paper currency, expanding its total supply at a faster rate, leaves long-term wealth eroded in real terms. It is precisely this realization that is driving institutional capital to re-anchor portfolios using physical assets, non-sovereign reserves, and hard strategic commodities as long-term balance sheet anchors. Looking ahead, the central question for investors is whether this monetary transition represents a short-term market cycle or the opening chapters of a permanent structural shift. While market corrections and short-term volatility are natural components of any long-term trend, the primary engines behind gold's march, unprecedented sovereign deficits, persistent central bank accumulation, and the steady erosion of fiat purchasing power, remain deeply embedded in global economic policy. As paper currencies face ongoing structural debasement, the historical relationship between fiat interest rates and commodity valuations will continue to evolve in real time. Navigating this changing financial landscape, requires a clear understanding of systemic risk, institutional mechanics, and the underlying forces shaping currency values worldwide. As monetary policy continues to respond to mounting public debt burdens, staying ahead of these structural shifts is no longer optional for serious investors. It is essential. We will continue tracking every policy shift, dissecting every market movement, and bringing you the deep macro analysis needed to navigate what comes next.